Hello all, I hope you are all doing good. My name is Dilip Chandra. I'm a qualified ACCA affiliate. In this video, I would like to discuss about IFRS 9 financial instruments. Now, this is a complex topic, so I'm thinking I would discuss this in categories in 4 to 5 short videos, specifically the financial assets. I hope you enjoy it. So when I say financial instruments, IFRS 9 says that a financial instrument is a contract which result in financial asset in one entity and financial liability or equity instrument in another entity. Now when I say contract, I'm saying we are looking at a piece of paper. Remember that. Now let's talk about examples. Let's understand this definition through an example. Example number 1. Let's say there is company A and company B. Imagine company A has sold goods on credit to company B. In the books of accounts company A, there is a receivable. Yes. In the books of accounts of company B, there is a payable. Now the company A's books of accounts, this receivable is called as financial asset. Now the payable, the company B has an obligation to pay back, right? This is called as financial liability. Financial asset done, financial liability done. Now let's look at another example, example 2. I say there is same company A, company B, but this time company A has issued equity shares. Okay, why? Maybe to finance, raise finance. Company A is trying to raise finance. Now company B has subscribed to those equity shares. Okay, company B has subscribed. What does it mean? Well, it means it is providing that finance. It is providing that funds to company A. Now, since company B has invested in equity shares, right? Invested in the equity of company A, sorry, it is a investment in equity. Since it is an investment, it is called as financial asset to company B. However, for company A, this is called as equity instrument. Okay, so the same equity is considered as financial asset for company B, equity instrument for company A. Now let's look at one more example, last example. There is company A, there is company B. Now this time company A has issued bonds. Bonds in the sense debt. Okay, now company B as usual has subscribed to those bonds. Now what do I mean by this subscription again? It's nothing but so company B is providing that finance to company A. Now since company B has invested in the debt of company A, investment in debt for company B, this is an investment in debt. Since it is an investment, we are considering it as financial asset. However, for company A, right, which is issuing the bonds and raising the funds, company A has an obligation to pay back. It has an obligation to pay back the funds it has raised from company B, maybe at maturity, maybe yearly, maybe in near future. Right? So company A has an obligation. Since it is an obligation, we are considering it as financial liability. So this is the idea, examples regarding financial asset, financial liability, equity instruments. Okay, so here the same equity, right? Same equity has resulted in financial asset to company B, equity instruments to company A. Here the same bond, right? Here the same bond has resulted into financial asset in company B, financial liability to company A. See here the credit sale, the sale contract. Here the equity contract. Here the bond contract. These are all contracts, right? So financial instrument is a contract which has resulted into financial asset in one company, right? Financial asset in one company, financial asset in one company, financial asset in one company. At the same time, financial liability, right? Financial liability or equity instrument in another company, another entity. Okay, now let's look at financial assets specifically. Financial assets. First of all, we have to look at classification. IFRS 9 says that classification IFRS 9 says that financial assets can be classified or categorized into three types. Number one, financial assets measured at amortized cost. Number two, financial assets measured at fair value through profit and loss account. Number three, financial assets measured, financial asset. Yeah. So let me just, financial asset measured at amortized cost, measured at fair value through P&L, and financial asset measured at fair value through OCI. Now, what do I mean by this amortized cost, or what do I mean this fair value through P&L, fair value through OCI? I will discuss this in the next video, the measurement video. Okay. Now let's just focus on the classification, because the IFRS 9 is a complex topic. If I discuss everything in one video, it will be very congested, very confusing. Let's take on step by step. Okay, now how do I classify a financial asset into these three categories? Now I know there are three categories. Financial asset will be categorized into one of these three categories. But I would like to know, how do I classify into one of these three categories? Is there any specific criteria? Yes, IFRS 9 says that, well, there is a certain test that needs to be met, right? Which is called as cash flow test. And also we have to look at business model of the entity. Okay, let's just first talk about cash flow model. Cash flow test. Cash flow test says that whatever the cash flows that are arising from the contract or financial assets, right? For example, here the bond investment, which has the company B has invested in the bonds. Now, when company B has invested, it would obviously expect some returns. What are these returns? Well, interest income yearly, and the principal at the maturity, right? So what are these? These are cash flows. Okay, so the cash flow test says that the cash flows that are arising from the let me choose the color. Yes, yeah, the cash flows that are arising from the financial asset are contractual in nature, and they are arising on specific dates. In such cases, such cash flows meet the cash flow test, and they reflect solely payments of principal and interest, right? The cash flows which reflect the solely payments of principal and interest, they meet cash flow test. Now, when I say contractual in nature, I mean, the cash flows arising from our sale contract, here our equity, here our bond contract. Okay. Now, what do I mean by these specific dates? What do I mean by these specific dates? Now, in our bond example, the interest income principal are arising, right? Let's say year one, the investment has been made. Year zero investment has been made. year 1, year 2, year 3, year 4, right? The company B would expect interest here, here at the end of year 2 interest here, end of year 3 interest, end of year 4 interest. Let's suppose this is the maturity, and here company B would expect principal as well, right? So the cash flows that are arising, are on specific dates, right? The cash flows that are arising on specific dates, which means I know when the cash flows are arising. At the same time, I know how much the cash flows are. How do I know how much the cash flows are? Well, when the bond contract has been entered into, there is something called as coupon percentage, right? So the company A would pay you this percentage every year, right? Nothing more than that, nothing less than that. Specifically on specific dates. So you do know when you are going to get the cash flows. You do know how much you are going to get. So I can say there is some sort of certainty here, right? So there is certainty here. If the cash flows are certain, right, they are contractual in nature, they are arising on specific dates, which means they are certain, they solely, they represent solely payments of principal and interest, the principal and interest, solely, only. Do you get anything more than the principal and interest from the bond investment? Do you get anything more or less? No, you will get whatever is specified in the contract. If such are the characteristics of the cash flows, they are contractual in nature and arising on specific date, they represent solely payments of principal interest, and they do meet the cash flow test, right? If the cash flow test is met, such financial asset is classified as debt investment. Okay. Now imagine there is a financial asset. The cash flows that are arising from that financial asset do not meet this category, do not meet this SPPI category. Can you imagine any financial asset which do not meet the solely payments of principal and interest category? What I'm trying to ask you here is, what I'm trying to asking you to think here is, imagine a financial asset or investment wherein the returns, right, when the returns are not certain, it means you do not know how much you are going to get. At the same time, you do not know when you are going to get. There is no certainty that you are going to get these returns. When? Can you think of such investment? Think. Yes, I'm talking about equity. I'm talking about equity investments. Equity investments. Why? Well, let's look at our example, our investment in equity example. Here, when company B has invested in company A, do you think the company B expect to get specified amounts of returns every year? Just like company B here has expected the interest income every year, it knows how much it is going to get because there is this certain percentage in the contract. Now, do you think the company B here in second example will also be expecting such returns? Will there be any certainty to the returns? No, no. Why? Well, because the company B has invested in equity, right? So here the nature of equity investment is such that company A has no obligation, right? No obligation to pay certain amounts to company B. Why? Well, because the name itself suggests that equity is residual interest. Residual means whatever is left. What do I mean by that? Well, company A, after paying to its I would say suppliers, right? After paying to its creditors, after paying to its debenture holders or debt instruments, debt holders, and then after paying to preference shareholders, after all these payments are done, whatever is left, only that amount will be given to company B, because this is an investment in equity. Whatever residue is there, that will only be given to company B, right? So there is no certainty here. Suppose in year one, right, year one, this leftover could be something more. In year two, it can be even more than that. There is also a possibility that in year three, it might be reduced. There is also a possibility that in year four, nothing could also be paid. Why? Well, because after the payment to all these people, right, there has nothing been left. When nothing has been left, company A has no obligation to pay anything to company B, because the investment in equity, the nature itself is that whatever is left, that will only be given to equity holders, equity shareholders, right? So here the cash flow test is not going to be met, because although they are contractual in nature, the returns are contractual in nature, they are not going to be arising on specific dates, because sometimes you are not even going to be get paid. At the same time, there you're not going to know how much you are going to get paid, because in 1 year it can be more, in 1 year it can be less. So since there is no certainty, such cash flows do not meet the cash flow test. So the cash flow test is not met. Therefore, those cash flows, those financial assets are categorized as equity investments. I hope you understood that. Now, once the financial assets are classified into equity investments, then now let's talk about the classification, further classification. Now, what do I mean by that? Well, financial these equity investments are by default are categorized as fair value through profit and loss account. This is by default. IFRS 9 says that. Also there is another thing. There is another option for any entity to classify the financial assets, the equity investments, as fair value through OCI. This is a designation. What do I mean by that? It means in the initial stage itself, initial measurement stage itself, you should designate the classification as fair value through OCI. You cannot do that later. Now, why like this, and why classification like this? There is certain other thing that you need to know, which I will discuss later. Because let's just keep the discussion now for the classification only. Okay, now the financial asset equity investments is done. Now let's talk about financial asset debt investments. Okay, so till now we have used the our cash flow test to see if the cash flow tests are met. Such financial assets are classified as debt investments. If those are not met, they are classified as equity investments. Now, after they are classified as debt, after they are classified as financial assets, classified as debt, now we further need to classify them into certain other categories. These three categories: 1, 2, 3. How do we measure? How do we classify them? There is some other category which is called as business model. Now we need to examine our business model. Let me just, here we talked about criteria, right? Cash flow test is done. Now we are looking at business model. Now what is this business model? Very simple. Business model. Now, when you invested in this financial asset, certain companies, certain entities, they intend to hold such investments till maturity, right? Which means they bought at the current period, they would hold the investment till the maturity date and do not, right, do not sell off in the middle. They want to hold till maturity. That is one business model. If that is one business model, your financial asset will be categorized as financial asset measured at amortized cost. Okay. If your business model is to hold, however, if there is a favorable situation, you also would like to sell off the asset. Now, what do I mean by this favorable situation? Well, say you bought it at 100, right? And now after maybe 2 or 3 years, the fair value is showing at 125. There is an increase in 25 and you would like to sell off this asset and want to encash this gain. That is the meaning of to sell. But you also want to hold, right? You want to hold. However, if there is any possibility to encash such gains, you want to sell, right? This is a mix here. If that is the case, then your financial asset needs to be classified as financial asset measured at fair value through other comprehensive income. Now, finally, the third category, if the business model is not this, hold till maturity, and not hold or to sell, there is other category. IFRS 9 says that there is other category, which means nothing but the trading. See here, the sole purpose of you, sole intention of your company's business model is to buy and sell, buy and sell, buy and sell, buy at certain level, sell at certain level. If there is a favorable situation, sell, right? Buy at low, sell at high, buy at low, sell at high. So you are trying to encash the gains. You're trying to encash the gains. This is your business model. Your business model itself is to encash the gains from financial asset investments. If that is the case, then your financial asset needs to be classified as financial asset measured at fair value through profit and loss account. So this is briefly the classification of financial assets. I hope that was clear and I hope you liked it. In the next video, I would be discussing about the measurement.